Carson. Thank you again for joining us. Today we want to talk about people are asking us, is it better when I'm negotiating on the purchase of a home? Should I reduce the price of the home or should I use that to buy down the rate? And what does that look like? And before we jump into that, because I think that's very important, I think you bring a lot of wisdom on that side. We have a lot of buyers asking right now, like, should we buy right now? What does that look like? And there's another video that you're going to be able to watch on that as well. But just the real quick bullet points on that people are looking at. If you were to look at our market, our local market, the Austin, Central Texas area, 6 months ago, if you wanted to buy a house as a buyer, you were going to go in and potentially buy a $500,000 house. You might have to bid up to $650,000 total. You would have to waive your appraisal rights probably. You're not going to be able to get anything on an inspection. You probably had to make 10 or 20 offers before you would get one. And buyers are crying out, just saying, like, we need a break. We need help here. And some of them were almost quitting. And for those who didn't get a house, it's funny that our market has shifted and we're now in a different aspect to where that $500,000 house that you normally would have to pay $650 for in this crazy market over the last couple of years, you can now get probably between $450 and $500, and you're not having to compete. And yes, interest rates have gone up, but you're not paying 10-15% higher for a home, and you have a little bit more time, but you can still jump in on what you're doing. So for those who were waiting for that opportunity and those who don't want to have to compete, because you tell me right now, rates are still good. They went up, they went down a little bit, but what's going to happen to our market again if rates go down later? What does that mean for competition? But I mean, what are your thoughts on it?
Yeah, big question, right?
Yes.
If we were to look back over the last couple of years, rates were really low, historically at all-time lows. In some ways artificially low because of the government's monetary policy and keeping rates low intentionally to help with the recovery from the pandemic. And that was a big catalyst, right? That really drove buying activity, right? People could move up to a bigger home, but because rates were so low, maybe lower than the mortgage they currently had, they could move up $100,000 in price and their payment didn't really change. And so if we believe the lower rates were a big catalyst that kind of helped spur the home buying activity and help create a lot more competition, so it drove prices up, then maybe the reverse is true, right? As we've seen since January, February, rates have gone up 2%. And when they were 2% lower, people were having to pay 10, 20% over list price and compete with 30 other potential buyers because there were literally 30 buyers for every home at one point, right? And I think it's important to remember that underlying dynamic doesn't go away overnight. I mean, there's still that strong demand for homes. There aren't enough homes, but people have paused. And buyers have paused because I believe because rates have gone up a couple percentage points, they're kind of, hey, let's wait and see. And then more inventory came on the market and the motivated sellers, some of them started lowering prices, and I think that kind of fueled buyers to say, hey, let's wait and see. Let's wait a little longer and see if these prices come down a little bit more, right? And when I look back at it just objectively and not emotionally, okay, so rates are a couple percentage points higher. On a $500,000 home, that's roughly $500 a month, higher in payment. But you now have such a great opportunity in that there are homes to choose from, and you don't have to settle on that house, and you don't have to compete with 30 other buyers, and you don't have to compete with the cash offers necessarily, and you don't have to pay 20% over list. And if the inspection report comes back, like you said, and it's not perfect, well, you can negotiate for some repairs. And before, you had no power as a buyer to negotiate. I'm just grateful to get my offers selected, right?
Yeah, and I know if I were to go back and talk to our buyers 6 months ago who were struggling to get a house and say, option A is you're in this market that, where there's multiple offers and you can't get a house, you have to go 150K over list and it's just crazy right now, you have no leverage. Or option B is interest rates are a little bit higher, but you don't have to pay as much and you don't have to compete. Which would you want to choose? We are having people come back now that went on hold that couldn't get a home and say, wait a second, I can actually go get a home and I can lock in my forever home or my next season home. And this is an opportunity to do that.
Such a great opportunity. If you if you listen to the economists out there, there's a really strong opinion that rates are going to continue to go down, that because of the raising of the Fed's rates and the slowing of the economy to help battle inflation that you hear about on the news, potentially entering a little bit of a recession, likely we will see lower interest rates over the next 6 to 18 months. I'm not sure when. And so if you have to settle on a 5% mortgage and you're sad about not getting a 3% mortgage a year ago, well, that $500 a month more in payment, I mean, if you were to really just think about the numbers of it, Robert, that's like what, $6,000 a year? $12,000 over 2 years, maybe $36,000 over 4 years or so, right? $6,000 a year that you're paying in a higher payment. And if you were to monetize that right over 2 years, 12 grand, that's pales in comparison to having to pay 100,000 plus over list. What's 12 grand versus 100 grand, right? No brainer.
Yes.
And if we're right and rates come down, there'll be an opportunity to refinance, and you didn't have to overpay for the house.
Well, and you brought that up to me and you said it, which I just thought was very smart, that what happens if the rates do go down? Everyone gets excited, right? But that means more buyers enter the market and you're back into a potential competition area. And if it's right for you, but you get your forever home now, it's not your forever interest rate, you're just in control. If this is going to be something you're doing anyway, you have now controlled your destiny in a sense of, I have the home, I can refinance, I'm getting appreciation now, I'm getting set up, and it just, versus waiting for a lower rate, do prices go up or down in that time, and then does more competition happen?
Absolutely. And so if you locked in a 5% rate today and rates go down, you could easily refinance and get the benefit of what the lower rate is in the future. And let's just say we're wrong and rates go to 7%. Looking back, you'll be really happy that you locked in a 5% rate. So either way, it's like, if you can get the right house at the right price and not have to compete with 20 or 30 other people, it makes it's not for everybody, but it makes right now such a great opportunity. I think it's an opportunity we haven't seen in 6, 7, 8 years, where there's homes to choose from and there's more homes on the market, and we're not having to compete and pay over list. And I know this will get into some of what we want to talk about today, but a home on the market for $500,000 that's been sitting for 30 or 45 days, in certain cases, you can go in and actually negotiate on option A, a lower price, and we'll talk through what that looks like, or option B, which I want to encourage people to think about, and something that we can walk through on an individual basis, is maybe we negotiate for the seller to pay some closing costs. We give them the $500,000, and there's some creative ways to use seller paid closing costs to buy the interest rate down. And I know that'll transition us into some other options here today, but options to temporarily buy down the rate for the first couple of years, or options to permanently buy down the rate. And they impact the payment in different ways.
And that's a big deal because most people aren't talking about this. And if buyers knew they had these options, some would use it, and some they just need to be educated on it. So you sent me a sheet. Can I share it on everything? And
of
you
course.
walk us through it?
And I think it speaks a testament to you guys, because you've been in the business long enough. But Robert, I can't tell you how many agents I know that have been in the business less than 5 years or so, and they've not seen a market where you can negotiate for the seller to pay closing costs. You didn't have a chance to get your offer accepted if you were asking for the seller to contribute towards the buyer's closing costs. And so many agents just don't have the experience and don't remember what a market was like, and may not know to ask for that.
Yeah, this is our 17th year when we started in a down market and what was going on. And so it was kind of a blessing in disguise, but be able to figure out, what do you do in these times? And there's ways for sellers, there's ways for buyers to make it all work. So, but this chart you put together, it made a lot of sense to me, but walk us through this right here.
You bet. So from the eyes of a seller and the eyes of a buyer, but this is kind of designed through the eyes of a seller. And if we feel like there's truth there that rates are higher and that's disincentivizing buyers to purchase right now, then what are some creative things that a seller can do to help attract a buyer and can help overcome that concern of, hey, my payment's $500 higher than it would have been a year ago? And so this simply walks through an example in the first row across the top of a $500,000 purchase price. So if a seller had a home on the market at $500,000, and if you scroll down that first column, you'll see that at just using an interest rate of about 5%, and you mentioned it, but by the way, you know, rates ticked up into the low sixes about 45 days ago, and they've dipped back down into the low fives with some options to get rates in the high fours. And so using a 5% rate is kind of a good, easy number to illustrate this with, right? And so with a 10% down payment, if you were to borrow $450,000, that would put your monthly payment highlighted in yellow down there at $24.40 a month. And we're just talking the mortgage. We're not talking taxes and insurance, right? The property taxes and the homeowner's insurance, or even mortgage insurance, if that's what we selected here. But a $2,400 monthly payment. And let's just say a seller said, okay, we're not getting activity on the house. We're not getting an offer. Let's do a $10,000 price reduction. And so this would illustrate a $490 sales price with the same 10% down and the same interest rate. And it would illustrate that the payment would actually go down. It goes down almost $50 a month. And it's $48.32, right? And so that's really, if you think about every $10,000 is about $50 a month in payment. So to save $500 a month, it would literally take a $100,000 price reduction, which is what this illustrates as well. If you go to the fourth column over, a $392 sales price with the same 10% down at the same interest rate is really what it takes to save about $500 a month. So if you scroll down just a little, you can see that payment of $19.22 versus $24.40. It's a $518 a month difference in payment. And so what that's doing is that's kind of illustrating what a 2% increase in rate has done to someone's buying power, right? It's about $100,000. So how can we creatively overcome that higher payment? And that's what this illustrates. So in column 3, what this is a 2-1 buy down. It's a temporary buy down. It's not a 30 years of a permanently lower interest rate. And the reason it's not familiar to a lot of people, Robert, is because in the last 10 years, rates have been in the 3s. There's been no need to buy the rate down much, right?
Correct.
And so you have a couple options. In this scenario, if we used about $10,000, the same $10,000 that the seller was willing to do a price reduction on, and repurposed that money to help lower the payment, the monthly payment, you then have two options. And so the first option that's not as common, that a lot of people don't know about, is what we call a temporary buy down. And it's where we do a 2-1 buy down. So follow me here. If the interest rate is 5% today, in year 1, they would make a payment based on a 3% interest rate. So that's the 2-1 part of the 2-1 buy down, right? So in the first year, the rate is temporarily 2% lower. And then in year 2, the rate is 4%. And then years 3 through 30, the rate is at 5%. So where this really makes sense is if we do think that, hey, I won't be in this house forever, or rates will come down, then I could do a 2-1 buy down, and the impact of that 2% lower rate, the impact of a 3% mortgage, has a monthly payment, if you scroll down in yellow, of $19.22 versus $24.40. Or in the second column, doing a $10,000 price reduction versus a $10,000 to buy the interest rate down, it lowers your payment about $500 a month, which again is equivalent to about $100,000 more in buying power for the same payment in that first year. Does that make sense?
That makes sense.
And so what's neat about this scenario, the seller would pay for it, but it would go into, and I won't get too technical here, but it goes into a buyer's escrow account. And as you recall, an escrow account is like a piggy bank for a buyer that you put your property taxes and homeowner's insurance into, and the lender then debits from that to pay the tax bill and to pay the insurance bill. Well, this $10,000 temporary buy down goes into this escrow account. And so the beauty of it is it belongs to the buyer. And so if in the first couple of years you were to refinance because rates do really come down, or your housing needs change, or you get relocated for work and you were to go to sell the house, that unused portion of that 2-1 buy down in those first 2 years gets refunded towards the loan. It pays the mortgage down. Compared to another option that's more traditional to where you said, hey, I have $10,000. I want to permanently buy the rate down. And that's over there in column, what is that, column 5?
Mm-hmm.
Let's just say that you were putting the same 10% down and you were going to use the $10,000 to permanently buy the rate down for 30 years. Now, if you didn't ever refi or sell this house long term, that would probably make more sense. It lowers your payment $226 a month. And highlighted there towards the bottom. Yeah. And that drops the rate in today's market maybe from 5% to 4.25%. Right. And if you were to really keep the mortgage 30 years, saving $200 a month, that adds up quick, right? $225 a month times 360 payments, that's $80,000 you save over 30 years by having the permanently lower rate. But if rates really do come down next spring and you could refinance, then you would have wasted that money to permanently buy the rate down. Let's say you would have alternatively just gone with the 5% rate, and rates, if they dropped 1 or 2 points to 4 or 3%, you would want to refinance, and you would have wasted all this money to buy a rate down that you don't need any longer if you sell the house or pay your mortgage off.
And it may sound complicated because we haven't seen it in a while, but it's really not. And to me, a potential buyer strategy is you could look up, because one of those strategy is, when you have to buy a home, you have to buy a home. That's part of what it is. However, if you have flexibility, there's now an opportunity in the market where you could look up as a buyer and say, interest rates are a little bit higher. I have more inventory on the market. I have more negotiation power. I'm going to be able to go after the home that I want. I could use this 2-1 buy down, or I could just even use if I want the long-term interest rate, because this is the forever home, you can do that as well. But then if interest rates go down, you can totally refinance. You have options. And the fact that people don't realize on these 2-1 buy downs, you can actually have that money in escrow and use that to refinance or pay less on the mortgage or whatever that is. Like that's a big deal. And that's a strategy, because again, if rates go down to where they were or whatever before, it's going to be another feeding frenzy, especially in our area.
Couldn't agree more, right? If you decided to wait, and other buyers are really saying, hey, maybe I wait and maybe prices come down. Well, maybe interest rates come down and the demand resumes levels that it where it were back in March or before March, right? Kind of at the peak, I would say March, April of this year. And if that activity picks back up, then you're going to be in line again and be at that disadvantage as a buyer when it's purely a seller's market, right? We're seeing the first time more of a neutral, where a buyer has an opportunity. It's more of a neutral market, right?
Again, we're not one of those that we push it out for everybody, but if I'm making strategy for buying a home and buying an investment property and what that looks like there is a lot of sense right now that's going to allow you to have control where you may or may not have that as much later.
I go back and look at my clients that bought a home 5 years ago and are coming back to me now, and it's literally they've got $200,000 and $300,000 of equity simply by more than what they've saved in 20 years of putting money into their 401k, right? It's that piece, that home investment is such a big piece of your financial wealth picture. I mean, otherwise you're paying rent, and I'm a landlord as well, and I'm getting the notices of value and seeing what my property taxes are going to be increasing to at the end of this year. And it's like my rent has to go up so that I can cover my mortgage. So we know what people are still moving to Austin. If they're not buying, they're renting. And we know that the rent prices are going up. And so, that's certainly something to consider as well.
Anything else on this that we need to know? So there's options. Your lender and your realtor should be talking to you, but if you can get a little bit off the price and $10,000 and potentially do a buy down or whatever, there's some strategies right now you can set your family up for success.
Absolutely. So I think the summary here is rather than making an offer lower than the list price, there might be a better way to use that money towards your closing costs or buying your rate down. There's probably a more creative way to repurpose that money rather than just strictly taking it off the price.
Having a smart strategy going in like that is huge. And when our buyers that are doing it now are just smiling from ear to ear once they see the big and long